Well, let's get back to Australia's unemployment rate, which lifted to 4.3% in June, which surprised the market and economists. And for more on this, I'm now joined by KPMG Chief Economist Brendan Rynne. Brendan, thanks for your time. Were you surprised
Hi, how are you?
Yeah, I'm good. Were you surprised with the unemployment rate lifting a bit from 4.1 up to 4.3%?
Look, unfortunately, no. I can say hand on heart, we have been doing our forecasts, and in our latest table, which we're yet to publish, we had actually an unemployment rate for June at 4.3%. And the reason for that is that most of the employment growth that we've seen more recently has come from government spending, either directly through the hiring of additional public servants or through additional spending that's resulted in employment in the non-market sector, so education, healthcare, those things. Employment in the private side of the economy has been very weak. And so we had been anticipating for some time that growth momentum on the public side of the labour market was going to slow, and it wasn't going to get picked up by the private side. And so that was going to push unemployment rate up to that 4.3%, probably another 0.1%, 0.2% over the back half of the year again, depending what happens with regards to interest rates. But we are seeing that weakness starting to come through in the labour market. Also, in saying that, it's monthly data, and we're still pretty tight. 4.3% is probably a level of full employment within the economy.
Yeah, so how does the Reserve Bank interpret these numbers? Because obviously they kept rates on hold at the start of this month, which was a pretty big surprise for the market as well. How will they interpret these unemployment figures?
The market was surprised. I was surprised. Frankly, I think they made a mistake in keeping the cash rate at 3.85%. Really, the risk associated with dropping that cash rate down in terms of getting an inflation bounce compared to providing some support into the private side of the economy, we think that risk trade-off is one that should have been associated with the drop in the cash rate down to 3.6%. So really, in the next meeting, we know that the Reserve Bank was saying it's not a matter of if rates are going to drop, it's just going to be a matter of when rates drop. And certainly, so we fully expect now that 25 basis points to come off at the next meeting.
Are you expecting more cuts as well towards the end of this year? Because we just had market analysts on before. The stock market's at record highs in anticipation of a series of interest rate cuts.
Yeah, so our forecasts are still anticipating the cash rate to be at 3.1% by the end of the year. So that means in total another 3 cash rate falls of 25 basis points each, so 75 basis point reduction overall over the remainder of the 6 months. We still anticipate that's going to be appropriate and necessary to help stimulate the private side of the economy, which is incredibly weak still.
Meanwhile, the Aussie dollar, it dropped yesterday off the back of those jobs numbers. I mean, it's about 65 US cents right now. Where are you expecting the dollar to end up at the end of this year?
Look, a really good question. I think that a lot of the strength that we've seen in the Aussie dollar over the last few months isn't necessarily because of the Aussie dollar, but because of the weakness in the US dollar. We have always thought, long-term fair value of the Aussie dollar is probably in the high 60, 70 cent mark range. What I think is going to happen is that we saw that change in the last day or so after the unemployment rate came out, because correspondingly you saw the Aussie dollar rise after the last RBA meeting where there was that unexpected keeping of the cash rate at 3.85%. So I think the market's just now starting to adjust back down to that cash rate of where we thought it was going to be now, but it is now going to be next month. But notwithstanding that, I think that you're going to see a weakness within the US dollar over the remainder of this year as tariffs start to really come back into full effect, and also the market starting to really understand what the fiscal implication is of this one big beautiful bill that's now been passed in the US.
And at the end of this month, we'll get the June quarter CPI figures. The RBA obviously wants to see those very closely, but what are you expecting? Is inflation going to remain sticky, or is it on the way down?
No, it will stay sticky. We do think it will be around that 2.5% for core inflation, slightly less for headline inflation. But what we do know is that headline inflation will bounce over the remainder of this year, coming back up a little as the full effect of the electricity rebates and cost of living rebates start to roll off. Notwithstanding those, we do think that inflation is still pretty weak, particularly goods inflation, and it's going to be that further rolling off of services inflation that's going to bring it down in total.
Brendan, Rynne, great to have you on the show. Thank you.